Most traders lose not because they're wrong, but because they enter at the wrong price at the wrong time with no confirmation. In this video, I'll show you a strategy that fixes all three, so you stop getting trapped and start entering like the institutions do. What you'll learn in this video: how institutional algorithms actually work, the smart money cycle, the sweep and flip protocol strategy, the institutional entry formula, the institutional fair value tool, how to buy from discounts and sell from premiums. By the end of this video, you will know when smart money enters the market, how to spot high probability setups in under 30 minutes, how to enter with precision, timing, and confidence. These strategies are built for the 15-minute time frame. They work on all markets: forex, crypto, stocks, futures, and commodity. Let's start with the first piece of the puzzle: how institutional algorithms actually work. Big institutions don't trade like you and me. They use powerful algorithms that scan the market for one thing: liquidity. Liquidity is just a fancy word for stop losses and pending orders. Most retail traders place stops below support or above resistance, and that's exactly where smart money is watching. When there's enough liquidity in one area, the algorithm triggers a fast move, a fake breakout or a spike, just enough to hit all those stops. Those stop losses turn into market orders, giving institutions the perfect entry with no slippage. But they're not selling the breakout. They're using that spike to enter in the opposite direction. That's why right after the sweep, the market often reverses hard. Retail traders are left confused while smart money is already in the trade. That's how the game works. The market moves to grab liquidity, not to follow your setup. If you don't understand that, you're not trading. You're being used for entries. For these algorithms to work the way institutions want, the market needs to be set up just right. And that's where the three-phase playbook comes in. This is the accumulation phase. The market moves sideways, nothing exciting, just noise. But behind the scenes, it's loading. Retail traders place stop losses below the range. Others get aggressive and place buy stops above it. Slowly, liquidity builds on both sides. Perfect fuel for the trap. Then comes the manipulation phase. A sharp spike, clean and aggressive, breaks out of the range and triggers stop losses. Traders think it's the breakout. Some enter late, others get stopped out. But it's not the real move. It's the trap. With liquidity now taken, institutions enter in the opposite direction, with full size and precision. This is the money move. The clean, directional trend that leaves retail behind. While most are stuck in confusion or revenge trades, smart money is already in, riding the wave they created. This cycle repeats every week, sometimes every day, and once you know what to look for, you'll start seeing it everywhere. Now that you understand how institutions trap retail traders, let's flip the script and trade like smart money. The strategy you're about to learn is called the sweep and flip protocol. It's designed to catch the real move that comes after the fake one, right when smart money steps in and retail traders get left behind. But to trade it properly, timing and structure are everything. We don't trade this setup all day. It's only valid during a specific window, at the end of the Asian session and the start of the London session, right when liquidity spikes and traps are triggered. You'll need one simple, free indicator to highlight the sessions on your chart. No clutter, just clear visibility. The strategy runs on the 15-minute chart. That's where we find the setup and execute the trade. But we always check the 1-hour chart first for smart money direction. A quick top-down view to stay aligned with the real trend. Let's break it down. As you can see here, this is the Asian session, and this is the London session. We'll use a free indicator to mark both sessions on the chart. Our job starts at the end of the Asian session. That's when we mark the most recent high and most recent low. This forms the accumulation phase. Then we wait for the London session to open, and that's when things get interesting. Right before the real move begins, a liquidity sweep is likely to occur. This is where institutional algorithms go hunting, scanning for stop losses and pending orders stacked above recent highs and below recent lows. And that's exactly what we're looking for too. Look at what happened. The market breaks the most recent high, sweeps the liquidity, then reverses and drops back below the level. This is classic institutional behavior, a trap engineered to fake out retail traders before flipping the direction. You'll find this setup frequently in the market, but it works best when it happens during the London session, as institutional algorithms often try to trap retail traders before making the real move up or down. And when you spot it, here's what to do. Sell at the close of the reversal candle, place your stop loss just above the sweep, target the most recent low. This is your bearish sweep and flip protocol setup. Now let's look at the bullish version. Again, this is the end of the Asian session. We mark the recent high and